Central banks are like the referees of a country's economy. They make sure things run smoothly. One of their main jobs is to keep prices stable. This means preventing inflation from spiraling out of control. Think of it like this. You don't want to pay $10 for a loaf of bread one day and $20 the next. Central banks also aim for something called full employment. They don't want too many people unemployed. That can lead to all sorts of problems, like people not being able to pay their bills. They also play a big role in keeping the financial system stable. They want to prevent bank runs and financial crises, which can really mess things up for everyone. Essentially, central banks are trying to create a stable economic environment. They want businesses to invest, people to spend, and the economy to grow at a healthy pace. One of the most important tools central banks have is interest rates. Think of interest rates like the price of borrowing money. When you take out a loan, you pay interest. When you save money, you earn interest. Central banks can influence these interest rates. They do this through something called monetary policy. When they raise interest rates, it becomes more expensive to borrow money. This can slow down the economy because businesses and consumers borrow less. On the other hand, when central banks lower interest rates, borrowing becomes cheaper. This can stimulate the economy as businesses and consumers are more likely to take out loans and spend money. Central banks are always adjusting these interest rates. They're trying to find that sweet spot where the economy is growing at a healthy pace, but inflation isn't getting out of control. Interest rates aren't the only tool in a central bank's arsenal. Central banks have a variety of mechanisms at their disposal to influence the economy and ensure financial stability. They have a few other tricks up their sleeves to influence the economy. These tools are essential for managing economic growth, controlling inflation, and maintaining employment levels. One of these is something called reserve requirements. This is a fundamental tool that central banks use to regulate the amount of money that banks can lend out. Central banks require commercial banks to hold a certain percentage of their deposits in reserve. This reserve acts as a safety net to ensure that banks have enough funds to meet customer withdrawals and other obligations. This reserve is held at the central bank itself. By adjusting these requirements, central banks can directly influence the lending capacity of commercial banks. When the central bank wants to tighten the money supply, they increase the reserve requirement. This action reduces the amount of money available for banks to lend, which can help cool down an overheating economy. This means banks have less money to lend out, which can slow down lending and economic activity. Conversely, lowering reserve requirements can stimulate the economy by increasing the amount of money banks can lend. Another tool is open market operations. This is one of the most frequently used tools by central banks to control the money supply and influence interest rates. This involves the central bank buying or selling government bonds in the open market. When the central bank buys bonds, it increases the money supply by injecting liquidity into the financial system. When they buy bonds, it injects money into the economy. This can lower interest rates and encourage borrowing and investment. When they sell bonds, it withdraws money. This can help to raise interest rates and cool down an economy that is growing too quickly. This buying and selling can influence the overall money supply and interest rates. Open market operations are a flexible and powerful tool for central banks to manage economic conditions. Finally, central banks can also use something called quantitative easing. This is a more unconventional tool that has gained prominence in recent years, especially during times of severe economic downturns. This is a more recent tool that's been used in times of economic crisis. Quantitative easing involves the central bank purchasing large amounts of financial assets to inject money directly into the economy. It involves the central bank injecting money directly into the economy by buying assets like government bonds or even corporate bonds. This can help to lower long-term interest rates and support economic activity. This is like a big economic stimulus package. By using these various tools, central banks play a crucial role in steering the economy, ensuring stability and fostering growth. Section 4. Ripples in the Pond: Global Impacts of Monetary Policy. In this section, we will explore how the decisions made by central banks can send shockwaves across the globe, influencing economies far beyond their borders. Central bank policies don't just affect their own countries. The actions taken by these financial institutions can have far-reaching consequences that extend well beyond their national boundaries. They can have ripple effects throughout the global economy. When a central bank makes a move, it can set off a chain reaction that impacts markets and economies around the world. Think of it like this. The global economy is interconnected like a giant spider web. Each thread represents a different country or market, and they are all linked together in a complex network. A tug on one part of the web can be felt throughout. When one central bank changes its policy, the vibrations can be felt across the entire web, affecting other countries and markets. For example, when a major central bank like the US Federal Reserve raises interest rates, it doesn't just impact the United States. It can make it more attractive for foreign investors to invest in the United States. Higher interest rates mean higher returns on investments, drawing in capital from around the world. They can get higher returns on their investments there. This influx of foreign capital can boost the US economy, but it also has implications for other countries. This can lead to a stronger US dollar. A stronger dollar can make US exports more expensive and imports cheaper, affecting trade balances. However, it can also lead to capital flight from developing economies as investors seek higher returns elsewhere. This movement of capital can destabilize these economies, making it harder for them to grow and develop. This can put downward pressure on their currencies and make it more difficult for them to manage their economies. A weaker currency can lead to higher inflation and increased costs for imports, further straining these economies. Central banks have to be mindful of these global impacts when they make decisions. They must consider not only the domestic implications of their policies, but also how their actions will reverberate across the global economy. What's good for one economy might not be good for another. A policy that benefits a developed economy might have adverse effects on a developing one, creating a complex web of consequences that central banks must navigate. It's a complex balancing act. Central banks must weigh the potential benefits and drawbacks of their policies, striving to achieve stability and growth while minimizing negative impacts on the global economy. The interconnected nature of our world means that every decision has the potential to create ripples far and wide. Section 5. Case Studies. The Fed and the ECB in action. Let's take a look at two of the world's most powerful central banks, the US Federal Reserve, the Fed, and the European Central Bank, ECB. These institutions play pivotal roles in shaping the economic landscapes of their respective regions. The Fed is responsible for monetary policy in the United States. It was established in 1913 to provide the nation with a safer, more flexible, and more stable monetary and financial system. It's tasked with keeping inflation under control and promoting maximum employment. This dual mandate aims to foster economic conditions that achieve both stable prices and maximum sustainable employment. During the 2008 financial crisis, the Fed took unprecedented action. The crisis, triggered by the collapse of the housing bubble, led to severe disruptions in financial markets and the broader economy. It lowered interest rates to near zero and launched a massive program of quantitative easing. Quantitative easing involved the purchase of long-term securities to inject liquidity into the financial system. This helped to prevent a complete economic collapse. The Fed's actions were instrumental in stabilizing financial markets and supporting economic recovery. Across the Atlantic, the ECB plays a similar role for the Eurozone, a group of 19 European countries that use the euro as their currency. The ECB was established in 1998, and its primary objective is to maintain price stability within the Eurozone. The ECB sets interest rates for the euro and also uses tools like quantitative easing to manage the Eurozone economy. It aims to keep inflation rates below, but close to 2% over the medium term. During the European sovereign debt crisis, the ECB played a crucial role in stabilizing the euro and preventing the crisis from spiraling out of control. The crisis, which began in 2009, threatened the stability of the entire Eurozone. It provided emergency loans to struggling countries and implemented various monetary policy measures to support the economy. These measures included the Securities Markets Program and the Outright Monetary Transactions, which aimed to lower borrowing costs for troubled nations and restore investor confidence. Both the Fed and the ECB have shown that central banks can play a critical role in managing economic crises. Their actions during times of financial turmoil have highlighted the importance of having strong, independent institutions capable of taking decisive action to stabilize economies. As the global economy becomes increasingly interconnected, the coordination between central banks like the Fed and the ECB will be crucial in addressing future economic challenges. Their ability to work together and implement effective policies will be key to ensuring global financial stability. Section 6. Why should we care? The importance of understanding central banks. Central banks might seem like these mysterious institutions, but their decisions affect all of us. Understanding how they work can help us make sense of the economy and how it impacts our lives. When central banks raise interest rates, it can affect everything from mortgage rates to car loans. It can also impact the stock market and the value of our investments. When they lower interest rates, it can make it cheaper to borrow money, but it can also lead to inflation. By understanding the role of central banks, we can be more informed citizens. We can make better financial decisions for ourselves and hold our policymakers accountable. Central banks might operate in the background, but they play a crucial role in shaping our economic lives.